The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to the ACECRT Financial Wellness Webinar Series featuring JP Morgan and First Quarter's Guide to the Markets and Economy. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we will take some time to go through these. Now I'd like to introduce our guest speaker from JP Morgan, Jack Montague. Jack is a Vice President and Client Advisor with JP Morgan Asset Management. In this role, Jack is responsible for delivering timely market and economic insights to financial advisors and their clients, as well as consulting them around the depth and breadth of JP Morgan's investment solutions. He has served over 10 years in the financial industry and is responsible for the Los Angeles and Mid-Coast region with JP Morgan. Jack is an avid golfer and recently became the father of his first child, Patrick. Jack and his wife, Kelly, currently live in Culver City, California. Thank you for leading us through this webinar today, Jack, and now I will turn it over to you.
Thanks so much, Tori. I appreciate everyone joining us on today's call, and I look forward to hearing some good questions from you guys at the end, as we are going to cover a ton of financial and economic data in roughly 35 to 40 minutes on today's webinar. So first, I'd like to thank Pension Mark and Tori for allowing us to be a strategic partner to the team, and go through a quick couple notes on why we are here today and why you're hearing JP Morgan. Obviously, JP Morgan is one of the most respected financial institutions in the world. We've been serving institutions, high net worth individuals, financial consultants, pensions endowments, and individual investors like yourselves for over 100 years. The power of JP Morgan really is based upon our investment capabilities and the people that make up our teams. We have over 900 investment professionals located in over 35 countries who we consider to be the best and the brightest in the world. And that's results directly in our portfolios and our mutual funds, seeing as we have over 50 4- and 5-star rated mutual funds rated by Morningstar. And we only point that out because we want to show the depth and the breadth of our product lineup. We never have to have an alternative agenda to push people in one direction or the other. Everything that we're going to give you today is pure market data. It comes from one of our intellectual capital resources. It's called the JP Morgan Guide to the Markets. It is by far one of the most commonly used tools amongst institutions and individual investors, printed over 100,000 times in 7 languages around the world every quarter. So without further ado, I'm going to dive right into this quarter's update. And what we're going to cover are 4 major themes. First, we're going to talk about oil prices and how they shape our view on the overall economy. Second, I want to talk about wages, unemployment, inflation, and what that's going to mean for interest rates in the U.S. The third thing I want to talk about is the investment implications of a rising dollar. And then finally, we are going to discuss the risks, the opportunities, and the needs for a balanced portfolio in the year ahead, as we are seeing a lot of major headlines and significant changes to the global landscape. So we're really in the 6th year of this expansion, and we are likely closer to the end of that expansion than we are to the beginning at this point. It has not been the longest expansion just yet, nor has it been the most impressive bull market in history, but we have seen the unemployment rate decrease sharply, and despite this, there are still investment opportunities in risk assets, i.e. Equities, and we're going to talk about fixed income shortly here as well. So let's dive right into page 28 of the Guide to the Markets, which addresses many questions that investors have about oil today. The first question is always, why did oil prices collapse? The left-hand side of page 28 shows that oil production has increased by 2.9% from 2013 to 2015. The U.S. is almost exclusively responsible for this increase in production, while we've seen European and Japanese consumption numbers been weaker year over year. In addition, OPEC did not decide to cut production quotas because it's not unified enough to make such a decision at this time. So this excess production and weakening consumption are directly responsible for the drop in oil prices that we've seen to the tune of roughly more than 50% in Brent crude and West Texas over the past 6 months. So where do oil prices go from here? As long as the global economy continues to grow, oil prices will recover, in our opinion. In the long run, there is a big supply and demand response, so prices tend to stabilize over 12-month periods following the uncertainty. And because of lower oil prices, people consume more while companies will produce less. There is rarely an immediate supply and demand response to oil prices, but eventually prices will balance out. This is evident on the right side of the chart of page 28, when oil prices dropped sharply in 2009. The big example here is that, in the 2008-2009 summer, oil was trading at roughly $120, 130 barrels, and that was not a significant sign that the economy was on a healthy footing. As we all know, the sharp turnaround in Great Recession that did follow that period. So we would also like to remind investors to equate the lower oil prices today, not indicating that the economy is down for a recession or some major pullback at this time. Oil prices are a supply and demand function, and because of the higher demand and weaker consumption, oil prices have fallen in the short term. So if we continue on to page 29, we can take a little bit more of a deeper dive into what it all means for the global economy. Despite volatility, lower oil prices are an overall positive, believe it or not. The right-hand chart of page 29 demonstrates that Canada and Russia are negatively impacted by low prices, as they are the smaller oil-producing countries. As for the U.S., it actually imported 1.6% of its oil in 2013, making us a net importer, and we will benefit from lower oil prices. On the other side, France, Germany, Japan, and China are also big beneficiaries of lower oil prices. Thus, lower oil prices in these countries are going to push up consumer demand and consumer incomes. In the U.S., the lower oil prices can actually hurt capital spending, but can also act as a transfer of wealth from corporations back to consumers finally. The top left-hand side of page 29 will demonstrate how lower income consumers benefit the most from lower oil prices. You can see that, again, that lowest income level is roughly spending 12% of its overall income on gasoline motor oil. So when you have lower oil at the pump, you will give the average, lower income, medium income class in the United States higher discretionary amounts of income, which they can go buy more dinners, they can buy new toys for the kids, maybe go on a new road trip. So it will actually go back into the economy as people spend more money. So lower oil prices in the U.S. not only help consumer spending, but they also help consumer confidence because, again, when you have more money, you feel more confident about the way things are going. Overall, lower oil prices act, believe it or not, as roughly a $100 billion tax cut and are very positive for the United States economy. So it's been a shock. If you're in the oil business or you have been investing in oil, your portfolio has been hurt. But for the rest of the economy and the overall consumers in America, it's actually been a big positive. So let's look at page 16, and we'll take a quick look at the economic growth and the composition of the United States gross domestic product. And we'll ask the question, why is consumer spending so important? The right-hand chart of slide 16 actually shows that consumer spending makes up roughly 68% of GDP in the United States. So in 2015, we expect capital spending, housing, and net exports to grow, but the major improvement year over year is going to, again, come in consumer spending. We expect consumer spending to grow at more than 3% annualized in 2015, which will bring us to roughly a 3% GDP growth this year, just above the historical long-term averages, slightly above what we saw in 2014. So the biggest impact of lower oil prices will be consumer spending, thus boosting the economy. And 2015 is already shaping up better than 2014 for the economy overall. You can't talk about the economy without talking about inflation, which is highlighted on page 26 of the Guide to the Markets. When we take a look at the last reading, the November CPI numbers were at 1.3% year over year and 1.7% on the core inflation numbers. So we do expect the inflation to reach 0% by the time the January CPI report comes out, which is largely due to the decline in oil prices. However, we are expecting that the core inflation rate to nudge up to around 1.8% overall. As oil begins to rebound, we will likely get better inflation numbers on a year-over-year basis going forward. Oil prices, one of the keys here, are not fundamentally deflationary, and in fact will actually add to consumer demand. It's likely by the middle of 2016, the headline CPI will surpass core inflation, and both will have moved up significantly. Now, the Fed is actually correct in their thinking that the disinflationary effects of lower oil prices are transitory. Essentially, it's a short-term supply-demand issue. Once you have people see lower oil prices, again, they spend more. They maybe, we're thinking about buying an electric or a gas-efficient car, but because oil is so much cheaper now, maybe they're going to start to spend more money on bigger SUVs, or again, taking trips, whatever the case may be. So cheaper oil doesn't last as long as people would expect because the behavioral trends of the end consumers will change along with it, hence driving demand in other places, which should then drive demand on oil, in which case we should have higher prices down the road. So let's take a look at the next portion of the economy that is a major impact for 2015. On page 24, we're going to dive right into the labor market perspectives. So the labor market has been a hot topic, and this slide will demonstrate the growth in payroll employment as well as the drop in labor force participation rate. So the Fed may actually be underestimating how tight the labor market is today, and the chart on the bottom right will actually show the ratio of number of unemployed people to the number of job openings, which is at its tightest level since the mid-2000s. So really what we have here is a high demand for labor, which should increase wages and continue to decrease unemployment, which we are going to focus on the next slide on page 23. So this is a great chart that shows the relationship between wages and unemployment in the United States. And what we believe is the most important thing to recognize at this stage is the significant fall in the unemployment rate here within our borders. We've seen it come down from roughly 10% in 2009 October to 5.8% in 2014. If you actually listen to the jobs report that came out on January 9th, it actually showed that the unemployment actually ticked down to 5.6% in the United States today. So if you look at the relationship between wage growth and unemployment in the past 30 years, there has actually been a negative correlation between these two, and we believe this negative correlation still exists. So essentially what this means when you're reading through the data is that as unemployment falls in the United States, it tightens the labor market, which means that there is a lower supply of unemployed individuals to fill open job positions, which means companies can pay us more for those individual employees, hence driving wages up. So we do believe that relationship to hold true again, as we've seen over history. So wage growth has been slow to pick up, mainly because people didn't realize we were in the midst of an economic expansion the past 6 years. The main benefactors of the past 6 years have been investors on Wall Street and corporate America, and it's only just coming around to the average consumer in the U.S. that maybe we are in a bull market, maybe we should spend more money, and maybe things are getting better finally. So now that the sentiment is changing, we may see some wage growth, which is an overall great thing for the U.S. economy and for the average population. So we talked about the economy. Let's take a look at the Fed and the implications all of this data is going to have on interest rates, because obviously that has been the #1 conversation piece among financial professionals, investors alike, and institutions. So we're going to focus a lot of our discussion on page 32 on the bottom right-hand chart, which actually shows the Fed forecast from their most recent December meeting. So the Fed is using what we call a three-legged stool. They're using GDP, they're using unemployment, and they're using inflation to judge their Fed's funds rate or short-term interest rate policy here in the United States. So the Fed is actually predicting, or forecasting rather, a 2.4% GDP growth rate in 2014, and that number should trickle up to 2.8% in 2015 and 2016. So roughly a 20% growth increase in the United States, which is very healthy forecast. The Fed is also predicting that the unemployment rate will only come down 0.5% between the fourth quarter of 2014 and the fourth quarter of 2015, dropping from 5.8 to 5.3. So we do believe this number to actually be inaccurate, and that the Fed is really misunderstanding the labor market dynamics that we went through on the previous slide. And we believe at JP Morgan that the unemployment rate will be at 5% or lower by the end of 2015, and even by the end of 2016, that number could be in the high 4s. So what does it mean? It means that the Fed, in our opinion, is actually behind the game with their estimation of 4 rate hikes in 2015 and 5.5 rate hikes in 2016. 4 rate hikes in 2015 is just not justified in this economy. We believe we should actually get 6 to 8 hikes in 2016 and about the same in 2017, hence driving interest rates higher over the long term. So what does this mean for the bond market? The 2-year yield is already increasing, but we do not see long-term rates rising that much. The problem for bond investors is that if we see even a 50 basis point increase across long-term Treasury bonds, coming off such a low yield environment, currently the 10-year Treasury is about 1.8 change, it would essentially wipe out the coupon and give you a negative return for the year. Thus, investors should really be underweight fixed income going forward, and if you are going to be owning bonds, you should be very selective within your fixed income to make sure that you're not buying the most interest rate sensitive investments and still buying bonds that have the ability to pay their coupons back to their bondholders. So let's break it down a little bit further. Let's continue on to slide 39, where we can actually show the high yield market. And the high yield market really didn't produce stellar returns in 2014, contrary to popular opinion heading into the year. This was because of a backup at the end of the year, largely due to energy high yield. The energy selection or energy sector within the high yield index roughly makes up 17% of the index in the United States. And as we saw a big sell-off in energy prices last year, so did the high yield market. Outside of energy, we do believe that default rates are going to be very low, and there's going to be plenty of opportunities within the high yield market with plenty of cash to go into high yield. High yield looks attractive to us, again, just outside of the energy sector. The opposite remains true for the European high yield on the bottom right chart. You can see the Euro high yield. There's actually no exposure to the energy sector. So this could be an opportunity to buy good cash flows, invest in strong balance sheets, get healthy coupons and high yield, and not expose yourself to the fluctuations of the energy and oil markets here in the United States. So someplace that you may want to look within this market is outside of our borders in the Eurozone. Overall, high yield is a place to look for. Another area that we like is on page 40. Again, somewhere outside of our borders for fixed income investors would be the emerging market debt space. Page 40 of the guide shows sovereign yields and their spread to treasuries over a 5-year maturity. In particular, we can point out a place like Brazil, where you can make 10% higher income than the U.S. Treasuries today. Now, Brazil will probably not default in the next 5 years, so if investors just hold their bonds until maturity, they can get 10% more just by simply going outside the U.S. There's obviously some credit risk in other countries around the world, but overall as a whole, there's opportunities in emerging market debt today. Moving forward, we've talked about, the economy, we've talked about the Fed, we've talked about some fixed income. Let's talk a little bit about corporate profits and earnings within the United States on page 8 of the guide. Page 8 shows that the S&P 500 is still seeing good gains in earnings. You can see in the left chart that the earnings in the United States coming out of 2008-2009 period have been steadily rising, and we actually predict the next earnings season will be above the $30 per share mark, even with the higher dollar and with lower oil prices, because we do think the economy is on a pretty strong footing. The lower than expected interest rates at the start of this year will also help corporations' earnings, and wages will go up as the year progresses, which should ship into the profit margins on the top right. You can see the last reading in the third quarter of 2014. Profit margins came in at all-time highs of about 10.1%. So we do expect companies to enjoy higher profit margins, but as companies need to increase their payroll for higher wages and adjust for that tightening labor market, that will nip into their overall profit margin. So companies should see high single-digit profit margin in 2014. And we do believe that the year will have mid-single-digit year returns, again, in earnings also. So mid-single-digit earnings, mid-single-digit profit margins should lead to an overall healthy earnings cycle for the S&P 500. Let's move forward and look at page 7 of the guide, which addresses one of the major concerns for equity investors today. Very simply, we're looking at the stock valuation measures for the S&P 500. Because the PE ratios today, the latest reading is 16.2, a little bit above the 25-year average at 15.6. So trading at above our long-term averages, but still not very expensive when you take a look at traditional levels. If you go to the bottom left chart, you'll see the S&P 500 index and the forward PE ratio going back to the early 90s, and then you can see periods in between the mid-90s going up into the 2000 era. Forward PE ratios were trading at north of 24 times. So the 16.2 on a relative historical basis, while high, is nowhere near the all-time highs that we've seen. So the stock market will probably rise this year unless we get hit by a major shock, a black swan, a geopolitical risk that, of course, we cannot model or predict. And with few alternatives within the fixed income or cash, because, again, it's such a low-yielding environment, the stock market appears to be a good option for investors. The bottom right-hand chart of this chart will actually show the relative S&P 500 earnings yield when compared to a comparable bond AA bond yield. So roughly stocks right now are at 6.2%. The bonds are about 4.7%. So roughly 1.5% of relative attraction or overweight to equities versus fixed income today. And as we see those margins and spreads begin to narrow, we'll reconsider our position. But where we stand today, stocks are still a relatively attractive area of the market. And it is still important to remember that as interest rates normalize and do trend higher and stocks get more expensive, we may only have gains in the mid-single digits and not benefit from the 13% return that we got last year in dividends on the S&P 500, but a slightly lower expectation this year. And rising confidence will probably cause more multiple expansion as it has done in the past. So where in the S&P 500 should we be? If you take a look at page 6 of the Guide to the Markets, you'll see the returns and valuations by sector. And this can help answer a really big question that exists for investors today of what am I looking for? The answer is usually I'm looking for a rising market, which means you need to be reasonably high beta to the S&P 500. You're also going to want to have a positive correlation to Treasury yields, so you may want to avoid sectors like utilities and telecoms as they are currently running at a very small line here. It's about 6 down. It says correlation to the Treasury yield. The utilities have roughly a negative 0.21 and negative 0.50 relative correlation to the Treasury market. So you want places that have a high correlation to Treasury markets, so your stock price appreciates up along with it. So while telecoms and utilities may have done well in the past year, they will likely not do very well in a rising rate environment, which means we want to change our positioning from last year to this year and be nimble and adapt to the changing landscape. We also believe that consumer discretionary, along with technology and financials, will do well with their higher earnings growth, and those areas generally have a high correlation to Treasury yield as well. So this is the type of environment where you need to select sectors that will not get hurt by rising rates, but will also benefit from a global growing economy. So let's take a look at the long-term drivers for growth on page 21. This is just a simple breakdown of how much longer we have, being, as we say, the best house in the worst neighborhood, and how long we can expect the U.S. earnings and growth to continue. So over the past 50 years, page 21 will demonstrate that the U.S. has managed roughly a 3% real GDP growth on the top right white box there. This has come from a breakdown of 1.5% growth in unemployment and a 1.5% growth in output per worker. However, in the past 10 years, output per worker has only grown by 1.1%, and it will likely stay around this level going forward. In the past 5 years, we've seen 1.1% growth in unemployment, most of which has come from falling unemployment in the U.S. So only 0.2 to 0.3% has come from an increase in the labor force. Thus, if the employment gets down to roughly, call it 4.5% by the end of 2016, it isn't likely to fall much further than that. So if the economy doesn't slow down at some point, it is going to hit a wall at the end of 2016, most likely. The only way out of this will be massive immigration reform to increase the labor supply. Otherwise, the slowdown is inevitable. So still good growth prospects for the short term, but nothing lasts forever, and we have to start thinking about changes to our capital market assumptions towards the end of 2016 in about 2 years. So we've talked a lot about the U.S. markets. Let's now focus our attention on the global equity markets. Page 42 will actually show how 2014 was a good year for the U.S., but a bad year for international investing. This was largely due to a stronger dollar, and the IEFA index in developed countries shows that the returns denominated in local currencies were actually quite positive, but because of the dollar rising by roughly 10%, U.S. dollar-denominated strategies suffered and were generally negative across the board. So this shows that a real problem for international markets was actually the rising dollar and not the growth of the companies within those local economies. So we still like people to invest overseas. We think that they always should have exposure to international investing. And the top right pie chart on page 42 will simply address the reasoning why. It comes down to the fact that if you take a look at the global market capitalization across the globe, the United States only makes up 51% of the investable universe within equity. So if you only invest in U.S. stocks, you are leaving roughly 49% of other companies on the table, therefore not taking advantage of all of the best growth opportunities that are made available. So there are some opportunities overseas, and we're going to talk about those shortly here going forward. So let's talk a little bit about the U.S. dollar first. The U.S. dollar on page 27 is at its highest levels since the early 2000s. This poses the question, where does the dollar go from here? And consensus estimates say that the dollar will continue to rise, but we are skeptical. Since the Fed will probably tighten interest rates at least as fast as markets expect, the dollar will continue to have positive forces driving it up. However, we do believe that Europe will actually do better than most people believe, and that will actually be a contrary negative for the dollar. So there's multiple factors taking into account here. And the left-hand chart shows that the U.S. actually still has a trade deficit. So if we don't enact some, again, immigration reform, tax reform, and get capital spending and the labor force growing, the U.S. will grow more slowly in the future. And at the end of 2016, the U.S. is going to be much less attractive than it was at the end of 2014. And if this is the case, the dollar may not continue to rise as much, and the dollar should not dissuade investors from capturing opportunities in international markets. There are opportunities for overseas, and as long as you have an active process and a reason for looking at those companies that should benefit from a higher dollar and the volatility that's coming there. So let's take a look at Europe. We understand what the dollar has done, but let's see just how Europe is doing as a whole. Overall, on page 47, you can actually see the cyclical headwinds as well as the tailwinds that Europe's going to be facing. Sovereign debt yields have come down, austerity has diminished, and Europe is going to benefit from a lower euro, which will help European exports in 2015. They also import a lot of oil, more than the U.S., which helps Europe's economy overall. And, of course, the stress testing that was done for the financial firms within the European is now over. So those companies don't have to hoard as much cash, and they can deploy that through lending and mortgages, really stimulate the spending of the overall economy through deploying their corporate cash. One of the major issues and one of the major the Eurozone does have an unemployment rate still at 11.5%. So Europe has a lot of room to grow. It's going to go through its troubles as they deal with the structural issues that they have overseas now. We think they're getting a good foothold on where this quantitative easing and bond purchasing program should be, as they just announced $1 trillion in spending. It's going to be to the tune of 60 billion euros each month, starting in March and going to September of next year. So hopefully that will, again, support a buoy and provide some stabilization for the region. But let's take a look at the valuations. We know what the valuations look like in the United States. Let's see what global equity valuations in developed markets look like. On page 54, you can actually see the composite valuation index, which looks at price to book, price to cash flow, and dividend yields. And the U.S. is the most expensive market among developed countries today. That's because people feel more confident. They feel that we have the safest economy overall relative to others, but that, of course, will drive up the prices. However, the dividend yield is also the lowest in the United States, with the exception of Japan. So because of valuations and long-term growth prospects, people should look outside the U.S. for longer-term investing opportunities. We can't talk about international markets without touching on the emerging markets and the demographics and development changes that are taking place in the emerging market story. You can see on the far left the impact of urbanization. The U.S. and Japan, far developed. We already have our infrastructure for the most part in place. But places like India and China still have a lot of room to grow in terms of building an infrastructure so people can move from the more rural areas of their country into more urbanized areas, therefore taking on, income-generating jobs. Maybe they work for software companies, technology companies, materials, whatever the case may be. But you can't allow people to get new jobs if you don't provide housing, water, sewage, transportation. So there's a lot of spending taking place overseas in emerging markets to bring the infrastructure back up to the developed world, and we think those projects are going to be great long-term investments for those countries. Overseas, in the emerging markets, we also really like an area like India. India has 38% of their population under the age of 20 today, and they spend roughly 35% of their GDP on investment, like infrastructure, which is also similar to Mexico, which shows the growth potential that's there. So really some long-term stories that are happening overseas, and if you have the time to wait out the infrastructure and the long-term projects that are now being implemented, you're going to be rewarded from an equity investor overseas in emerging markets. So again, we talked about valuations on U.S. developed international markets. Let's talk about the emerging market valuations on slide 55. Slide 55 will actually show how emerging market stocks are now trading at a cheaper value by a full 1 standard deviation, actually, than the all-country world index, the developed world market index. So the ones we like best, again, are India and Mexico. which is not surprising that they're the most expensive. It's kind of like the U.S. They're the most attractive from an investment standpoint. You're going to have to pay a premium for those solid projects. And people do need more exposure to emerging markets in the long run. They're only going to grow in size, and they're only going to become a more important part of your portfolio overall down the road. So let's just wrap up here. We'll talk about page 56 in asset class returns. One of the biggest things that we stress at JP Morgan is building strong, solid portfolios and diversified portfolios. This chart shows the returns in individual calendar years and the best performing sectors or asset classes in that calendar year. And you can see no one can predict the future. You know, one year, emerging markets may be the best. The next REITs, the next will be international or the U.S. So predicting which asset class is going to be the strongest performer is next to impossible. So we do recommend building a diversified asset allocation involving all these asset classes and sectors and countries around the world, and you will smooth out the overall ride and performance and the volatility of your portfolio. So 2014 overall was a good year. An asset allocation strategy did roughly 5.2%, and while the S&P 500 and the Barclays Act did higher than that, it was still a smoother ride in terms of the volatility profile. Commodities dragged in 2014, and international stocks were hurt by a rising dollar. In 2015, some of the big risks include, of course, the Eurozone and the uncertainty that's happening there. There's some issues around Vladimir Putin and Russia and some of the things that they're doing from a geopolitical standpoint. And then, of course, there's some debt problems still in China and Japan. Nevertheless, there is still a lot of potential. The global economy is still growing despite lower oil prices, and it's still time to be overweight risk assets, in our opinion. The only difference is that investors need to be much more selective about the sectors, the countries, and the instruments that they're using because the markets aren't as cheap as they once were 6 years ago. And most importantly, people need to be diversified going into a new year to take advantage of all the opportunities in the U.S. and around the world. So with that, that ends my formal comments. Tori, if you want to open it up to any questions that we may have, we'd be happy to address those now.
Absolutely. Thank you, Jack. We appreciate you sharing your time and knowledge with everyone here today. And as Jack mentioned, we will now start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to ACECRT's Financial Wellness Program. The number is 844-ACECRT-8, or you can email at financialwellness@acecrt.com. Our first question, how will environmental limitations in relation to oil impact our economy? What about the effects on employment as the oil industry is quite vast?
So there's two answers there. The first part of the question comes to the environmental issues regarding lower oil prices and the effects that that's going to have. Lower oil prices are going to negatively impact the amount of exploration and production that the shale oil and natural gas industry is going to spend in trying to drill for new natural gas and drill for new alternative fuels, very simply on the price basis, where companies no longer have an urgency to drill as fast as once expected because they're getting such cheap oil. It's also going to have a slowdown in production because when you have negative oil, a lower oil price, you're going to have some of these exploration companies and production companies in North Dakota, South Dakota, have to trim employee headcount and cut back on some of the resources that they do have because they've modeled in higher energy prices. So unfortunately, the answer is that as oil does trend lower, it is going to negatively impact some of the advancements that we've seen in the alternative fuels, if you will, in the United States. The second part of the question, if you could repeat that for me, Tori.
Sure. What about the effects on employment as the oil industry is quite vast?
So again, very similar answer here. The employment in the oil industry is going to negatively impact those directly affected by energy prices. So a lot of companies that exist, we noticed that within the high-yield sectors in the United States, there's roughly a 17% allocation to energy within that high-yield market. Now, high-yield debt is issued to fund exploration and production, amongst other things, within those sectors. They all do model in, again, 85, 95% oil prices. So at these lower bases, the companies that originally were expected to be profitable are no longer going to have the earning potential and profit margins that they once did, which will alleviate their free cash flow and the ability to pay back the high-yield coupons that they have associated with their debt. So unfortunately, within that specific sector, unemployment should go up as lower energy prices will have a direct impact. Across the rest of the, call it U.S. Employment sectors, those not directly affected by energy prices should see little impact, if at all.
Thank you, Jack. Our next question, what is your prediction on energy ETFs?
I think that it's an area that people should be looking at. The ETF market is by nature a passive instrument, in which case you are buying generally a market cap weighted or a specific sector or subsector of an individual energy market. The problem with ETFs has always been that you are buying both the winners and the projected losers in any individual sector. So ETFs work great in rising tide environments because generally all things tend to improve as one. When you see a dislocation, as we've seen in the energy market, you are going to have clear-cut winners, i.e. an Exxon or a Mobil, which will have free cash flow, which isn't going to be really negatively impacted by direct oil prices because they're large integrated oil companies. But if you, again, focus on the ones that are just exploration and production basis, they're going to be much more negatively impacted. So when you buy an ETF, you're buying the entire broad market. We would recommend that you use an active management stance, specifically in energy today, because not all companies are going to be reacting to these new prices and the new energy landscape as one. So it's an area that you can use. Just be very selective in the areas that you are playing, or find an actively managed mutual fund or an actively managed product that may better suit your needs in that area.
Thank you, Jack. It would appear that there are no more questions at this time, so this will conclude our webinar session. Thank you again, Jack, and thank you, attendees, for your participation. I hope everyone has a great day, and we're looking forward to our next webinar series with you. Take care.
Thank you so much. Have a great day.